This is the Asia Trade. I'm Shery in Tokyo.
I'm Heidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. More whiplash for traders as the Trump team suggests that some tariff relief may be on the way, just a day after new levies kicked in. That comment helping US stocks pare losses after a global sell-off. Ahead of the president's address to Congress, Commerce Secretary Howard Lutnick says that Trump may meet Canada and Mexico in the middle on trade.
It's not going to be a pause. None of that pause stuff, but I think he's going to figure out, you do more, and I'll meet you in the middle some way, and we're going to probably be announcing that tomorrow.
And I'm Stephen Engel in Beijing, where President Xi Jinping has again left the door a bit open for trade negotiations with the United States, offering a calibrated response to Trump's increase in tariffs. We'll have live updates all morning as the NPC begins here in Beijing.
Before that, we do get GDP numbers out of South Korea at the moment, just crossing the Bloomberg. This is the fourth quarter preliminary GDP, and of course, really key when it comes to how we see South Korea as being one of these very externally vulnerable, trade vulnerable economies, really impacted not just by direct tariffs, but the deterioration in broader trade conditions. The fourth quarter GDP expanding 1.2% year on year. That was a previous estimate was the same. The quarter on quarter expansion of 0.1% was also unchanged. 2024 GDP at 2% growth, also the same as the previous estimate. Of course, a lot of headwinds when it comes to the Korean economy, Shery, from these growth woes to the political uncertainty, as well as a broader sentiment and some of the household debt issues as well.
Yeah, we have seen that market reaction already with industrial production numbers, manufacturing in South Korea declining, bond yields declining. Take a look at how U.S. futures are setting up, because we're seeing S&P 500 futures gaining 0.6%. A little bit of a bounce back, of course, as we got those comments from the Commerce Secretary talking about President Trump potentially lowering those tariffs on Canada and Mexico tomorrow. And this is coming after the worst two-day drop since December for the S&P 500. So are we seeing the Trump put back, of course, is a key question. That idea that President Trump could intervene to prevent really market pain, because we had really seen a big sell-off in U.S. markets, considering everything that's happening on the trade side of things, on geopolitics as well. You can see oil prices in the Asia session under a little bit of pressure, but in late trading, we had a little bit of a bounce back as well. We're following U.S. dollar because it's continuing to hold losses given the tariff news. The BB-Dixie at around that 2-week low, but on the other side of that trade, we also had a very strong euro extending gains above 100-day moving average. So take a look at how we're setting up for the Asia session as well, because we had seen some losses for the Nikkei. The Japanese yen fell in the overnight session. We're seeing this dynamic of haven buying given the tariff news, but also at the same time, Prime Minister Ishiba coming out and denying that Tokyo is trying to weaken the currency after President Trump accused Japan and China of gaining an unfair advantage through FX policy. Of course, big news today is the National People's Congress in China, and we're expecting to see those growth targets, CPI targets as well, Heidi.
Yeah, two big events, two major speeches in the coming hours. A lot at stake for markets and the global economy. President Trump will address a joint session of the U.S. Congress, and China's Premier Li Qiang will open the NPC in Beijing. Let's bring in on the ground in Beijing our Chief North Asia correspondent Stephen Engel, and in Washington we have with us our Bloomberg Balance of Power co-anchor Joe Matthew. Joe, let me start off with you first. We're not calling this a State of the Union, but what are we expecting from this speech from the president?
It's a great question, and that's what we're all asking right now. He's got a lot of time to play with. The president could speak an hour and a half or more. They've carved out a couple of hours for this address to a joint session of Congress, which is his first opportunity to do so in 5 years. We don't call it a State of the Union until about a year has gone by, but that's essentially what we're talking about here. And there's a lot in the air. Yes, tariffs, beginning with tariffs, with so many questions about what happens as soon as tomorrow when it comes to these new levies against Canada and Mexico. How about China getting much less talk today in Washington because of the back and forth with our two immediate neighbors? But let's remember, China imposed tariffs, retaliatory tariffs of up to 15% on a bunch of agricultural products. President Trump talking more about reciprocal tariffs in April, and we'll probably have an answer to what we heard from China. I will also point everyone to tax cuts, the budget resolution, and the attempt to get a massive reconciliation bill to put forth the Trump agenda. He's going to be looking at the very lawmakers who are crafting those bills. But much more immediately, the government is set to run out of money in 10 days. And whether we have a government shutdown might have a lot to do with all the other stories that I'm talking about here. This president will likely need Democrats to pass a continuing resolution to keep government operations underway following the middle of March. And that is the backdrop of this speech tonight. When you add the layer of DOGE and the cost cutting, the federal worker layoffs that have been underway, we're looking at a lot of angry Democrats who are going to be in the room tonight, many of whom may well be protesting what the president has to say.
Steve, just as Joe mentioned as well, when it comes to the National People's Congress in China, looming large is the trade tensions, the tariffs, of course. What are we expecting to see today?
Well, I don't think they're going to be talking specifically about the tariffs. They're going to be talking about the challenging external environment. Li Qiang, the premier, giving his annual work report, essentially marching orders for the provinces to deliver what is expected to be a growth target of around 5%, which was the same target that they set last year and met by the end of the year. But the challenges obviously are mounting with the tariffs, given that much of that 5% growth that we got last year out of China came from exports. It's more challenging now with these threats and the reality of now 20% tariffs on Chinese products. So, you know, the measured approach that we got yesterday from Xi Jinping and the Chinese leadership to the escalation in tariffs from 10 to 20% was an interesting development, considering, you know, in the first term of Donald Trump, China responded quite, more harshly, including sort of weaponizing the yuan, where we saw the yuan weaken about 11.5% over 2 years in response to that first trade war. They also went heavily on soybeans, and we saw soybean exports from the United States to China drop some 80%. Now, they did target soybeans again this time yesterday, but again, a bit of a more measured approach to the retaliatory steps, maybe saving some arrows in the quiver for further action if the Trump administration does decide to go further on those tariff threats upwards of 60% as threatened on the campaign trail.
Keeping some of their powder dry for sure, Steve. But I do wonder, we're already hearing, Howard Lutnick mulling potential very swift, at least partial tariff relief when it comes to Mexico and Canada, if there's a pathway to compromise here. Does such a pathway potentially exist for Beijing too?
There's always a pathway, obviously. Donald Trump sees himself as a bit of a negotiator. Oh, sorry, didn't mean to step on the rest of the panelists
Steve,
there.
Perhaps,
but again, Howard Lutnick was a...
Steve, perhaps we get the view from Beijing first, and then we'll throw it over to Joe to see kind of, what the possibilities are from what he's hearing in DC.
Sure. So just to surmise, essentially, Howard Lutnick said this, at least in the first round here, is a drug war, not a trade war. So keep in mind, one of the reasons why Donald Trump escalated those tariffs in the last couple of days from 10% to 20%, the reaction is they haven't gotten a lot of communication out of Beijing on the steps that they are taking to curb the precursors from allegedly going from China into places like factories in Mexico. So Donald Trump and that administration wants to see more concrete steps and pledges out of the Chinese. But keep in mind, Xi Jinping and Donald Trump have not had a phone call since the first round of tariffs were put into place. There's not been open top-level dialogue. Yes, there's been back-channel conversations, but the conventional wisdom is that China has not necessarily done enough, because the state media so far out of China in the few days that I've been here, to cover the NPC, the constant narrative is the drug problem, the fentanyl problem in the United States is a domestic U.S. problem based on demand for those drugs. It's not a China problem.
And Joe, just as Heidi was talking, what are the chances right now that we might see some compromise with Beijing? But just before getting there, take a listen to what the Mexican president had to say about the damage to both economies.
But it is inconceivable that no thought is being given to the damage it will cause both U.S. citizens and U.S. companies as a result of the price increase of goods produced in our country, as well as the damage it will cause by putting a stop to job creation in both countries. Nobody wins in this decision. On the contrary, it affects the people we represent.
So, Joe, negotiations seem to be very active between the U.S. and Mexico and Canada, but what happens with Beijing?
It's really unclear right now, and if you listen to the rhetoric that's coming from the administration today, they are making clear that this is actually not about trade today when it comes to Mexico and Canada, that this is about opioids. This is about the drug war, that the trade war, in fact, won't come until April when the retaliatory tariffs are brought forth. The Commerce Secretary made that point repeatedly in interviews today, saying that we need a material reduction in autopsy deaths from opioids. It is very unclear what exactly that means or how these countries, whether it's Canada, Mexico, or even China, would be able to react to that, to be able to meet that metric, because we're just not hearing specifics enough from the White House. That's partly why this speech tonight is going to be very important. And, of course, the spin that follows it. Will we get direct statements from President Trump on that later? We'll have to see. But he is clearly putting Canada and Mexico in a different bucket than he is China, and that has been the line so far in this White House.
Steve, it's really interesting. We're seeing playing out across Europe at the moment this push for rearmament, this sort of really existential change to the security commitments across the region, right? To what extent are we seeing that sort of pressure from President Trump also play out when it comes to Beijing's policies, when it comes to their growth agenda, you know, how this potential kind of revival of private sector tech might be playing into this as a defense to Trump tariffs and Trump trying to kind of reshape that relationship?
Well, sure. So we get the work report later today where we'll get that growth target. We'll also get the defense budget. It'll be very interesting to see how much of an increase or what the number will be as far as the outlays for the Chinese PLA, as well as domestic innovation. Clearly, the new productive forces are still in effect. They're looking at putting more money into strategic new industries. And obviously, the deep-seek advances in AI are a development that the Beijing leadership is watching very closely. The domestic innovation will be front and center, as well as policies, fiscal numbers. They're likely to raise the budget deficit target to GDP from 3% upwards of 3.8. We've seen some estimates upwards of 4%, the highest it would be in 3 decades. Clearly, this is a domestic economy response to the outward pressures that they're seeing. But right now, this domestic economy is sputtering because a lack of confidence and a lack of spending from the consumer. So we'll have to see what that fiscal number is going to be coming from the work report and the marching orders to the provinces to deliver that growth of around 5%.
Right, Stephen Engel there joining us from Beijing, as well as our Washington correspondent and Bloomberg Balance of Power, Joe Matthew, as well. We'll bring you the latest when it comes to tariffs, as well, of course, as the National People's Congress in Beijing. Coming up on the Asia trade, Standard Chartered explains how Trump's tariffs are impacting the FX market. We discuss what to expect from China's MPC with Societe Generale. Plus, we'll hear exclusively from Malaysia's Minister of Economy after a deal which could see the country manufacturing its own made in Malaysia chips. More ahead. This is Bloomberg.
It's a new information set, and the opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession. And so it's a bit of now uncertainty. And what the election originally people grasped to was certainty. Markets like certainty.
You've got to take that longer term approach and hope, or maybe expect at some point, that they'll get to outcomes, markets will calm, and actually in a moment like this, you look around and say, are there good businesses that are now on sale? We can deploy capital into this volatility. Let this tariff diplomacy play out a bit.
Some of our guests from our Bloomberg Invest event. These tariff risks, of course, are now playing out in the currency space. We are seeing the Bloomberg Dollar Index at a 3-week low. And we have seen on the other side of the trade, the euro rising to fresh 2025 highs. Of course, we have some idiosyncratic news with Germany announcing that they would reform their debt brake. On the other side of that trade, we're watching the offshore yuan as well, which actually gained ground in the previous session with the PBOC having a more aggressive fixing, a stronger fixing to support the currency. The Aussie holding steady, but the Canadian dollar, the peso under pressure given the tariffs. The Japanese yen, you do want to watch out for that one because we continue to fluctuate, but at the same time, given President Trump's accusation of Japan and China of trying to gain an unfair advantage through their currency policies, Prime Minister Ishiba here in Japan actually denying those allegations. For more on the currency markets, let's bring in Stephen Englander, the global head of G10 FX research at Standard Chartered Bank, who joins us now. Stephen, so we continue to see perhaps President Trump, Washington trying to put the dollar in play when it comes to some of these national security, economic goals as well. How will that play out for investors?
Well, it's complicated. I think in the first instance, the market sees the imposition of tariffs as a dollar positive. Whether in the long term, their goal of getting the dollar weaker is possible, that the tariffs, the short-term effect of tariffs are most important. However, what we're also seeing, as we saw today, is that you impose very tough-sounding tariffs yesterday, and today you sound as if you're trying to walk them back a little bit. I think that's part of the reason CNH is trading with a 725 handle, and part of the reason why the euro is doing so well. It just, the market is kind of discounting it.
Is this just a short-term blip, given, of course, what we're seeing in the tariff space? And if we continue to see President Trump just basically cry wolf when it comes to applying these duties on other countries, that the reaction will start to fade as the year progresses?
I think that certainly is a risk. And, again, if he pulls back the tariffs on Canada and Mexico entirely, I think that will be a bigger risk, and we'll probably see, China continue to rally and other currencies continue to rally against the dollar. I think ultimately the issue is going to be how much can he get other countries to buy from the U.S., whether it's defense equipment from Europe and Canada, whether, China buys agricultural commodities and other things from the U.S. I think that's what he's aiming for. And that's what Bessent seems to emphasize in his conversation. It's just, it's unclear whether that's, completely in sync with Trump or whether Trump is looking for a more aggressive stance on tariffs.
Stephen, you write a bit about the complex kind of ambitions for the dollar, right? And we've historically talked a lot about China's impossible trinity when it comes to the yuan. When it comes to the simultaneously achievement of all the goals under the so-called Mar-a-Lago Accord, do you think that's also quite unlikely?
I think you can lay out a scenario in which it all works. It's not a traditional market scenario in which you sort of say, okay, what's, in a free market, what's the demand for dollars? How much capital is going into the U.S.? What's the current account deficit? How does it all balance out? There would have to be an element of intimidation there, where countries agree to either take a haircut on their holdings of U.S. assets or to buy U.S. assets at a discount or accept that the coupon payments are going to be taxed. I mean, it's all possible, but I'd say that if he actually achieves his goals, which is reducing the trade deficit, keeping money flowing into the U.S., keeping the dollar as the world's reserve currency and the currency of financial transactions, it's going to be very hard to weaken the dollar. That's just not a scenario in which you say, yep, dollar down 10% on that basis.
I wanted to also get your view on the flip side, particularly when it comes to euro-dollar trading, right? Our question of the day asks how long until we see that pair hit 120. There's a lot of global strategists either now advocating euro longs or at least exiting very quickly their euro shorts, right? What do you see the pathway here?
Well, look, we thought for a while that the dollar was ahead of its skis at the end of last year and the beginning of this year. The U.S. growth seems to be hitting a air pocket here. And we saw in 2020 when Europe announced a significant fiscal policy that there was euro strength. We tend to think it's going to be relatively temporary. We think that the market will focus on fiscal policy in the second half of the year when the reconciliation bill seems closer. We expect that it will provide stimulus and U.S. rates will back up again. So, we think there's room for further correction. We don't think that this is going to be a long-term move.
Stephen, when it comes to the Chinese yuan, going back to the trade war and the implications for Beijing, we have seen them actually allow the yuan to weaken during the first trade war with Washington during President Trump's first term. What are the risks if this happens again during President Trump's second term?
I'd say there's a risk. We don't see the risk as being enormous. China's export sector is doing great. There's no issue there, no need to depreciate. And, it's not unclear whether any country would welcome a weaker CNH, not just the U.S., but other countries are kind of conscious of this. So there's a longer term agenda that they have of making CNH kind of a more important currency in international transactions. And from that point of view, stability, I think is pretty attractive. And they seem to be very careful. They know they have to retaliate, but they don't want to provoke the U.S. into, even more precipitous action. So they're moving, I think, quite carefully. And from discussion that we've heard, there are parts of the Chinese export sector that are in a position to kind of absorb the tariffs. That their cost advantage is really big. So yeah, they can take it.
Stephen, really great to have you with us. Stephen Englander, who's a global head of G10 FX research at Standard Chartered Bank. More ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up for the market opens in Japan and Korea. We already have the ASX 200 trading at the moment, downside of 0.7%. Every sector in the red as we continue to digest those tariff news. More ahead on the Asia trade. This is Bloomberg.
And so we'll see how this early move on the chessboard plays out. People are assessing, companies are assessing the implications. But for the most part, there's a long-term view that is now being contemplated. We've not seen this level of tariff, at least in modern times. We've seen it historically, the implications of which historically have been pretty dramatic.
That's Lazard President Ray Maguire there speaking at the Bloomberg Invest Forum in New York, where our next guest describes the latest U.S. tariffs on Canada and Mexico as a huge own goal for Washington. Heidi Crebo-Rediker is the fellow at the Council on Foreign Relations and joins us now. Heidi, really great to have you with us. And, we sort of heard from our previous guest saying that long-term view is now being complicated. People are scrambling to try and make these new assessments. But even the short-term view is complicated, right? How difficult is it to see a remedy, a pathway when the policy mix and consistency from the Trump administration is so sort of unexpected right now?
So, I mean, obviously the tariff action today was a pretty big shock for all of the companies that operate in the North American supply chain. And you know, Canada and Mexico are our two biggest trading partners. So I think there was a reluctance from the corporate community and from the financial community to really think that President Trump would move forward with such substantial tariffs on two of our best allies and trading partners. But you know, the bigger picture is this uncertainty that's now been introduced. It will have a lot of second and third order consequences. And I think one of them is that the friendshoring model that companies spent and invested in for the past several years post-COVID, that was a huge disruption to their business models. It was a huge disruption to actually, and a huge investment. And that business model has now been flipped on its head. So the fact that we actually have the first round of tariffs being applied at scale on Canada and Mexico is really astounding. And I think you're going to see the tariffs continue to escalate against China over time. But it's very hard for our trading partners globally to actually juggle and read all of the multiple agendas and how to scenario plan on how to actually respond. Because if the goal of the tariff isn't clear, the remedy is also unclear. So I think that getting to the goal and the remedy is going to be a challenge for a lot of our trading partners.
And from the outset, it would seem that it makes more sense, the sort of journey to be able to find compromise with partners like Canada and Mexico is clearer than being able to do that with Beijing, right? Do you sort of put China in a separate category in terms of how much this will ultimately escalate and become a longer-term shift in that trading relationship?
So I do think I put China very much in a different category because we have a lot of instruments and restrictions on China that are multifaceted and serve different goals, because China is a long-term strategic competitive, I guess, and not an antagonist. I'll just say what it is. And I think Trump wants to eventually strike some kind of a grand bargain with China. It certainly didn't happen during Trump 1.0. And I think that when we were talking about the phase one, phase two, it was really quite a disappointment in terms of what the end results were. When you talk about how he's implementing back to Mexico and Canada, though, I think what's been captured is that he is applying these tariffs under an executive authority because we are under an international economic emergency. And that is just, I think, dangerous territory, particularly vis-a-vis Canada. The goal was to stem fentanyl and illegal migration coming from Mexico. But I think, you're going to see a continuation of tariffs over the next couple of days and weeks that will prove highly disruptive, I think, to companies and to business plans for the next several years.
But when it comes to policymakers in Beijing, for example, given that these are presidential directives, does it give them a feeling that they just need to weather through the next 4 years? I mean, if President Trump continues to cry wolf and threatens these tariffs, even despite the shock that we saw on tariffs on Mexico and Canada, within the day, Commerce Secretary Lutnick is coming out and saying that perhaps there might be compromise. So what is Beijing taking away from all of this?
So I think that they're probably hoping to keep a cool head. I think their retaliation was surprisingly muted. They had, an increase on tariffs on food and agricultural products, but it was fairly measured. It wasn't really escalatory. I always look for weaponization of critical minerals as one of their chokeholds where they could really do some damage in sort of an asymmetric response. But they did not do that. So I think that they're trying to watch, wait. It's obviously an important time right now for the Chinese to develop their next 5-year plan. And so the layering on of the tariff risk is something I think they're going to watch and wait and see how it plays out over the next couple of weeks and months.
So if we continue to see these tariffs and the continued threats, who loses out the most here? Because we have seen China, of course, experience Trump 1.0. So a lot of their trade has been diversified away from the United States. How much has Washington been able to do that in the past few years?
So, yes, there's been a China plus one strategy for many companies to actually diversify, and they've done an excellent job in diversifying their trading partners, particularly in the global South. But I think that at the end of the day, we always have to remind people in the United States that it is the consumer that ends up paying the tariff, and that whether you are a consumer of intermediate goods as a small business, if you are a farmer, you just saw your Canadian fertilizer, which we import about 85% from Canada. That is now much more expensive, and I think that the end result is that you're going to see different companies in different sectors disproportionately hit, and that comes from how companies decide they want to either capitulate or engage or give concessions or retaliate.
Heidi, before we go, I wanted to get your views on the reshaping of traditional U.S. alliances too, right? When it comes to that White House meeting with Zelensky, there's a lot of nervousness when it comes to traditional alliances here in Asia, here in Australia, for example. Do you think all of this is going to be drastically reshaped through this administration?
So I am deeply concerned, because I think that when we are undermining our closest alliances on the international economic front, and we see what happened after the Oval Office meeting between President Trump, J.D. Vance, and Zelensky, I think it was deeply concerning to not only to our Asian, not just our European friends. They're quite nervous. I do think that the minerals deal that was talked about and negotiated, I think it's still alive. I think there were rumors it was going to be signed today, but I understand that that's not actually the case. But cutting off of the military aid yesterday to Ukraine spooked our European allies and our allies in Asia. The idea that we could pull back on intelligence sharing, we really we're in a very, very different place where, I think there's a serious case to be made that Putin is really calling the shots here, and that we have a team of Rubio, Waltz, and Witkoff who really have no experience negotiating with Russia. So I think we're in dangerous territory here, and I think we're at risk of losing the trust of our friends and allies.
Heidi, Crebo-Rediker, good to have you with us, Senior Fellow at the Council on Foreign Relations. As we continue to watch other geopolitical stories as well, leaders of Arab countries have endorsed Egypt's Gaza reconstruction plan in a move to counter President Trump's proposal for U.S. takeover of the Strip. An Arab League emergency summit backed the 5-year, $53 billion plan for temporary housing, rubble removal, and the return of the Palestinian Authority to Gaza. It also calls on the UN Security Council to deploy peacekeeping forces in Gaza and the West Bank. Israel says it's giving Hamas several days to rethink terms for a new Gaza ceasefire. A 6-week truce expired on Sunday, with the sides divided over core conditions that would bring an end to hostilities. During the first phase of the truce, Israel recovered 33 hostages in return for hundreds of Palestinian prisoners. Israel on Sunday cut humanitarian aid to Gaza for the first time in more than a year.
Take a look at Shery when it comes to commodities markets reacting to all this tariff uncertainty. You're seeing oil, they're pushing lower after we heard from Commerce Secretary Lutnick saying that the administration could walk back some tariffs on trading partners Mexico and China. A lot more uncertainty being injected when it comes to the demand side of things as well. We have seen that trend low when it comes to crude since about mid-Jan, as these trade policies continue to raise the prospect of trade wars on multiple fronts, hitting energy demand. Gold is another interesting one that we're watching, continuing to rise, of course, in terms of haven demand, but we're seeing a little bit of a pullback now. We have had that, of course, consistent investor flight to haven assets, but some of those price dislocations when it comes to gold are starting to fade. Shery.
And Heidi still ahead on the Asia trade. China's National People's Congress set to review the nation's emissions reduction targets. A surge in power demand and new rules on renewables pricing put plans in jeopardy. A closer look next. This is Bloomberg. China's annual Congress this week is set to assess the nation's progress on its five-year plan, including energy, security, and renewable power. Beijing is already expected to miss this year's emissions reductions targets, with expanded manufacturing adding to power demand. Analysts say the government would need to cut 15% of its steel capacity this year to meet 2025 climate goals. At the same time, China's renewable energy sector is facing a new challenge as the government introduces market-based pricing for wind and solar power projects. The rules may slow clean energy additions while adding to demand by lowering consumer electricity prices. For more, Bloomberg NEF China research manager CC Tang joins us now from Beijing. CC, of course, we continue to follow the National People's Congress in Beijing today as well. For any hints on what could happen in this sector, what are we expecting?
I think for the, as you mentioned, on the power market, I think it's a very big move for China because it mandates all solar and wind generation to be traded in the market. It's 4 years ahead of schedule. And I think China has already hit its 2030 target for wind and solar installations. So the new phase for renewables is less about like government guaranteed purchase, but more about market-driven competition. There are a lot of rumors whether China will slow down its installations. So our take is, in the long term, yes, but in the short term, we are expecting, especially this year, we are expecting a smooth transition between policies.
What do you think about the decarbonisation targets and how that feeds into the future of renewables in China?
Exactly. What else do you think?
I think for the decarbonisation targets, we are seeing it at two parts. On one hand, China has already hit its 2030 target on solar and wind installations. But on the other hand, we don't think China is on track to meet its 2025 carbon intensity targets. So there will be a lot of efforts needed to really hit that target. In the long run, I wouldn't doubt China's commitment to decarbonization because of the country's leading position in the clean tech sectors as well as clean tech deployment. So I think this year is definitely worth watching because it's how China sets its next 5-year targets, as well as how China submit its NDC, its nationally determined contribution, basically set up its 2035 plan.
Bloomberg NEF's CC Tang there with us. We have more ahead on the Asia trade. This is Bloomberg. The latest from the corporate front, and a BlackRock-led consortium has agreed to buy control of key ports near the Panama Canal from Hong Kong-based CK Hutchison. It comes after pressure from President Trump to limit Chinese interest in the region. The deal includes the bulk of CK Hutchison's ports division, which produced 20% of its earnings before interest and tax in the first half of last year. Goldman Sachs is set to start its annual round of job cuts, moving the exercise to earlier in the year after previous reductions took place in the latter half. The lender is said to be cutting between 3 and 5% of staff, in line with prior moves. The Wall Street Journal earlier reported that the bank will focus on reducing vice presidents after it added too many in recent years. Amazon has reportedly formed a new group focused on agentic artificial intelligence. Reuters citing an internal email from the AWS CEO Matt Garman saying the technology has the potential to be the company's next multi-billion-dollar business. The report says AI agents are designed to automate tasks for users so they don't need to prompt systems to take actions.
And we're setting up for the Japanese market opens. The yen has been fluctuating. Of course, we do have haven demand coming from the concerns around the tariffs. We're seeing that 149 level being held early in the Asia session. This, as we have already heard from Prime Minister Ishida, denying President Trump's accusations of Japan and China weakening their currencies in order to gain advantage over the U.S. Nikkei futures pointing to the downside are really reversing some of those earlier gains that we saw after Commerce Secretary Ludwig mentioned some potential for compromise in the Canada-Mexico tariffs. Here in Japan also, Oasis management urging cosmetic maker Kao to heed its proposals to improve operations and boost growth. Oasis says it manages more than 5% of shares in the cosmetics and chemical products maker. CIO Seth Fisher told us that with a little help, the company could become a global brand.
Kao can be a global champion, can be Japan's champion to the world. Kao has lost money in cosmetics recently, has continued to only make a very small amount of money and lost a massive amount of market share in health and beauty products compared to all their global competitors, or the substantial, serious global competitors. Kao is overexposed to Japan, can grow internationally. I want Japan to continue to grow, but I want internationally to grow even more, and I think they have an incredible opportunity. They have the benefit of incredible brands, just simply incredible brands that they should focus on. And that needs help in supply chain. That needs help in pricing policy. That needs help in kind of business focus and transformation and kind of product. That needs focus in terms of marketing, and certainly online marketing and social media marketing. And the gap that they have between the increased revenues and earnings that the major competitors have and them with not having grown substantially at all, or actually in some cases lost some money, is because they haven't focused on these key areas. And so we've nominated directors to help them in each of these key areas.
I see. And do you think other shareholders will side with your proposals this time?
We've heard an enormous amount of support for our proposals. We've heard an enormous amount of all these issues that we're talking about, the lack of social media. This is all empirical. You can go look at who their social media followers are and all the different brands. It's 1/10th, 1/20th, 1/30th of their competitors. We've heard from other shareholders about how hard it is to get in touch with management and have a meaningful dialogue with them. We've heard how hard it is for people to even understand. We've done certain investor surveys. Do you understand what global sharp top means? And do you understand what the plan? Is there a plan? Are they aggressive enough? Are they trying to grow enough? Are they searching for growth? Right? We've heard from shareholders and other investors have they made smart M&A? Do they overpay for M&A? Right? And then we've gone out and talked to consumers and customers. Right? Do you like the brands? We love the brands, but we find it hard to find the brands. We find it hard to purchase the brands from all different types of sources. Is it in Sephora in the States? Is it available easily online? It's not. Right? And so we continue to hear these things from customers who say, I want to buy it, but I can't find it. Right? And we continue to hear it from investors that I want to engage and I want to understand the strategy and I want to have them to have more ambitious goals, but they don't have them. And so let's have, yes, they think that this help is needed at the company. So yes, I'm optimistic about winning.
Oasis Management CIO Seth Fisher speaking with Bloomberg's Hideyuki Sano here in Tokyo. And Hide joins me right now because, of course, we've been talking about this corporate governance reforms and a lot of activist investors being more active in the markets here in Japan. But now you have a layer of the tariff threats. What sort of moves are we seeing in the broader markets right now?
Good morning. So, yes, you talk about corporate governance, and that has been the key forces in the market. But in the recent months, investors are starting to second think about what best strategy will be in Japanese market. And if you look at the stock performance this year, so-called reversal factor is working, which means that basically if you buy the worst performance last year, and if you sell the best performance last year, you made profits. That the return was plus 3%, whereas the quality strategy, where you buy sort of good companies, like companies with low debt or company with stable growth, the long-short strategy based on quality factor is minus 3% this year. So it seems like investors are trying to modify their positions because there's such a huge uncertainty at the moment. So rather than chasing this trade, people are pulling their bets off at this point and trying to figure out what they should do next.
So just quickly then, how long will this contrarian stance really remain?
I think the jury is still out on that question. Some people think that things might change in April because foreign investors tend to buy Japanese stocks in April and they tend to sell in March. So that's basically a not good sign for the Japanese market. And when the market is down, normally you don't see a strong momentum in growth stocks or quality stocks. But on the other hand, there's uncertainty from Trump to contend with. And as we all know, he's highly unpredictable. He changes his policy very quite often. So reversal may work quite for a long time.
Bloomberg Senior Asia stock reporter Heidi Kusano there. Let's take a look at the yuan at the moment as we look ahead, of course, to the National People's Congress, and in particular Premier Li Qiang delivering his government work report. We are expecting that growth target of around 5% for this year. We've seen some relative stability in the yuan with some supportive PBOC fixings.
This is the Asia Trade. We're counting down to Asia's major market opens, and at any point now we could be getting lines from the National People's Congress in China. We're expecting that work report, the budget report, an economic direction and spending plans for the year ahead coming from Beijing. All of this, Heidi, of course, as we're watching those trade tensions between Beijing and Washington.
That's right. The core question is really how much do we see in this sort of economic blueprint that reflects the pressure that's coming externally, but also, of course, Beijing has plenty of its own domestic challenges to contend with as well. We are seeing pretty muted expectations when it comes to what these markets are feeling right now, Shery.
Yeah, not muted when it comes to the reaction in the markets, though, because we have seen in the overnight session those safe haven trades really acting up, especially given that those Trump tariffs went into effect on Mexico and Canada. But at the same time, we heard from the Secretary of Commerce in the U.S. that there could be some compromise. Take a look at the Nikkei now gaining 0.2% early in the session to reverse those losses that we saw in the previous session. The Japanese yen holding steady. We have seen a lot of pull and push when it comes to the Japanese currency, especially given that it's perhaps acting a little bit as a haven currency. But at the same time, we heard from Prime Minister Ishiba denying accusations from President Trump that it's really weakening the currency in order to gain an advantage against the U.S. Some comments that he made against China as well. Take a look at the Kospi coming online as well. Little changed in the previous session, given, of course, this push and pull when it comes to the trade tensions, how it could affect the Korean market. But we're seeing that upside early in the session. We got fourth quarter GDP numbers earlier today showing barely any expansion of 0.1% quarter on quarter. The Korean won strengthening right now. But it's really about those two big events in the coming hours, right? Because it's not just about the NPC, but President Trump will also be addressing a joint session of the U.S. Congress. And at the NPC, China's Premier Li Qiang will open the annual meeting. Joining us now in Beijing is our Chief North Asia correspondent, Stephen Engel. And in Washington, we have Bloomberg Balance of Power co-anchor Kaylee Lines. Steve, let me start with you on what we can expect from the NPC.
Well, obviously, they need to stimulate the local economy against the backdrop of the more protectionist nature from the Trump administration. At least that's the common narrative here coming out of state media. And that, they're going to retaliate, and they have retaliated. But it's been a fairly measured retaliation so far with the announcements coming yesterday from the Ministry of Commerce. Here at the National People's Congress, of course, in about an hour's time, we're going to get the annual work report from the Premier Li Qiang will get that growth target set. Probably around 5% is the conventional wisdom. That was the same target we got last year. And lo and behold, by the end of the year, they hit that target of 5%. But on the back of export growth, that will be a little bit more challenging. That's why we're going to have to dig into the details of the work report and see what kind of fiscal outlays we're expected to get. Remember, the agenda for the National People's Congress was pretty much set by the party leaders in December at the Central Economic Work Conference. The speculation is, since we didn't get big bazooka stimulus then or at the third plenum, we did get stimulus in September. The confidence, though, and the pledge fatigue kind of set in. That's why all eyes now are on the work report to see how far they're going to expand the budget deficit target to GDP from 3%, perhaps as high as 3.8, even 4%, and flood this economy with trillions of yuan of stimulus to get domestic consumption going and kind of help this economy weather the external shocks.
Steve, of course, it's not just tariffs and trade directives, but we know there are multiple levers that we've seen Washington pull even prior to the Trump administration coming back. And we're now hearing from reporting in the Wall Street Journal that the administration is preparing an executive order aimed at reviving U.S. shipbuilding and cutting Chinese dominance of the global maritime industry. So readying an order to bolster U.S. shipbuilders, according to this draft summary, including 18 measures ranging from raising revenue and fees on Chinese-built ships and cranes entering the U.S. to setting up a new office at the National Security Council for the domestic maritime sector. So a number of measures there now being considered, apparently, with the preparation of another executive order. And Kaylee, I wanted to get to you. What are we expecting to hear from really what has been an emboldened President Trump in the first couple of months of his second presidency, right? It's not a State of the Union address. Is he expected to kind of still treat it as such?
Yeah, and for all intents and purposes, you will see the pomp and circumstance that typically comes with the State of the Union. It's just not being called that because he's only been back in the office of the presidency for about 6 weeks. And typically with the State of the Union, they've been in the job for at least a year. All the same, we are expecting the president will speak much about what he has done in the past several weeks that he's been in office and everything he still wants to see done going forward, including, of course, tariffs on countries like China. And I know you're getting some breaking news on that right now.
Right. Kaylee, let me take over because, yes, you're right. We're getting the 2025 GDP target from Beijing at about 5%. We're also getting the CPI growth target around 2%. These are very important because the growth target now is around that 5% level for the third consecutive year. When it comes to the CPI target as well, we have seen that being lowered to 2%, around 2%. We have seen it around 3% in previous years. Let me just bring back Stephen Engel right now to just digest these numbers because we are now seeing the GDP target and CPI target. So analysts had expected a sort of around these numbers to come from Beijing, Steve.
Yeah, I think the growth target of around 5% was the worst kept secret in China. That is something that they did last year, and they're going to do it again this year. The big question is how are they going to get to that number when, of course, the domestic consumption proportion of GDP growth has fallen back considerably over the last year as confidence has waned. Exports really took the dominant bulk of that. Exports might be under more pressure, obviously, given the external shocks coming from the tariffs of the Trump administration. And where is all that excess industrial capacity in EVs and batteries and in other industries? Where is it going to go? Well, it's going to likely go into the domestic economy as the most viable end result right now. But again, we have to see the kind of policies that they're going to stimulate that kind of demand. As far as CPI, that too was expected to kind of set a little bit of a lower bar for CPI inflation. It's been fairly tepid so far. It's been very low growth in the low single-digit percentage. We're seeing, though, factory gate deflation persisting for more than 2 consecutive years now, and that is also the reason why we're likely to see quite a significant push on the fiscal side to try and at least end.
Yeah.
They've tried to tackle it by the end of last year, the deflationary trend. Now they have to conquer it and get back into inflation.
So, Steve, We are getting those lines on the fiscal side of things. China planning a 2025 budget deficit at around 4% of GDP. This as seen by Bloomberg on that government report where we got those numbers. But yes, as you said it, Steve, what do you make of the 4% of GDP 2025 budget deficit?
That's a significant increase. That means they're going to be unleashing fiscal stimulus. Now we just need the details of where and how deep, obviously. 4% of GDP as a budget deficit target would be the highest in 3 decades. So you can kind of see the significance of the problem and the challenges facing the Chinese economy.
Kaylee, we've also heard just sort of overnight the Commerce Secretary Lutnick talking about a potential pathway to compromises with trading partners like Mexico and Canada when it comes to those tariffs. Are we likely to see such an option be available when it comes to Beijing?
If there is one, Heidi, we haven't heard about it yet. We could hear some of that from President Trump when he addresses this joint session of Congress scheduled to take place just about 2 hours from now here in Washington. But what the Commerce Secretary said was that they've been in talks with Mexico and Canada specifically, and that potentially there could be some kind of middle ground reached that would see that tariff level, 25%, which just went into effect on Tuesday in Washington, rolled back or lowered at least by as soon as Wednesday here in the U.S. On China, though, it's a different story, it seems, at least to this point, knowing that the administration is arguing that this is not right now a trade war. They're calling it a drug war, and a lot of the fentanyl products that is coming over the U.S. borders by via Mexico or Canada is originating in China, at least those drug-making materials, and that really is what the administration says is at issue here. So we could expect to hear more from President Trump about tariffs specifically during the speech tonight, given that this is an area in which we see his economic policy and foreign policy kind of colliding through economic statecraft. But obviously there's still much more we expect him to discuss tonight, including issues here at home like his tax policy. He would like the body he is addressing, both chambers of Congress, in order to pass. So you can see an extension of his tax cuts, what else he's doing when it comes to the U.S. border, trying to shrink the size of the federal government, and of course other foreign policy issues as well, including the war in Ukraine and the negotiations he would like to see move forward to end it after there's been a lot of drama and back and forth between him and Ukrainian President Volodymyr Zelensky in the last week.
Steve, still just passing through the numbers, the key numbers from this work report, and largely it sort of falls in line with economists' expectations. They expect the stimulus package and the fiscal measures to be announced today to be kind of evolutionary as opposed to revolutionary, right? To what extent is Beijing kind of keeping some powder dry, both when it comes to, domestic stimulus efforts, but also countermeasures that it could use against the United States?
Yeah, that's right. So those countermeasures that we saw coming from the Ministry of Commerce yesterday were fairly measured, excuse the pun, in the sense that China still needs to import a number of these food crops that obviously they targeted. They learned some lessons as well from that first trade war in the first term, and they wanted to perhaps as well save a few arrows in the quiver because, again, half of America's soybean exports are to China, and China needs to import soybeans. One thing that they did learn, though, is to diversify their sources. So between the first Trump administration and this second one, we've seen countries like Brazil take up a much bigger proportion of the exports to China to fulfill their food needs. But again, the large crops like corn and sorghum, they're also going to be taxed between 10 to 15%, along with a lot of other agricultural products like pork and chicken and beef. So it's fairly measured right now. It was only the first round after the 10% tariff that Trump announced in early February. It was on about 80 products, U.S. products, the tariffs, amounting to about $14 billion. This second round that we got yesterday was $22 billion. So nothing compared to the potential impact of the U.S. tariffs on Chinese imports. Again, there's no like for like because basically America buys more than 3 times more goods from China than the other way around. So you'll likely see a measured approach from the Chinese leadership as far as not wanting to provoke further tariff action from the Trump administration.
That's our Bloomberg Chief North Asia correspondent Stephen Angle there in front of the Great Hall of the People, as well as our Balance of Power co-anchor Kaylee Lyons there in Washington ahead of President Trump's big speech as well. Take a look at our markets that are trading at the moment, are sort of reacting to all of this uncertainty. This is a picture when it comes to just about an hour and 15 minutes into the start of trading here in Australia, 0.7% lower, tracking for the ASX. We're also seeing a little bit of downside when it comes to the Aussie dollar, always kind of playing out as a proxy of China risk there, but we have seen the greenback kind of holding on to most of its losses on the news of the sweeping tariffs on Canada and Mexico and China taking effect. Global risk sentiment when it comes to that has just been so volatile. We're seeing treasuries there looking like this at the moment, particularly when it comes to that move in the short end as well, with traders piling into bets that the Fed will have to resume cutting rates as soon as May if these tariffs truly go into effect and truly upend what is already seeing signs of a weakening US economy. We're also watching oil at the moment, which has been sort of persistently trending lower since about mid-January. Again, these tariff concerns, and also awaiting for news of further stimulus measures out of China as well. So we continue to count down to the opening of the China's National People's Congress. Societe Generale will be joining us with their expectations on policy measures next. This is Bloomberg. Take a look at what the yuan is doing at the moment, which has been propped up with quite a bit of stability when it comes to the recent supportive settings from the PBOC. Of course, a big day as we have that delivery of Premier Li Qiang's work report at the National People's Congress. You can see that a view outside the Great Hall of the People in Beijing this morning. We did get some numbers when it comes to that work report. Nothing was really hugely unexpected. The 2025 GDP growth target at about 5%, where it's been for the past 3 years. The CPI growth target at around 2%. The 2025 budget deficit at around 4% of GDP. Also, a few more targets, a deficit of 3% energy use per unit of GDP when it comes to that 2025 target. And we're also seeing aiming to add more than 12 million urban jobs to the labour market in 2025 as well. Let's bring in Michelle Lam, who's a Greater China economist at Societe Generale. So does any of this sort of jump out at you as being surprising or noteworthy? I suppose that 5% GDP target in particular has been seen by a lot of economists as being pretty optimistic, particularly in light of the external pressures on China right now.
Yes, it is quite an ambitious target, but I would say that so far most of the details are in line with our expectations. I think what I will be paying attention to is really the size of the special CGBs that we will find out later on. Because, as you mentioned, China is under a lot of pressure. Externally, the U.S. announced that there may be another 10 additional % of tariffs on Chinese exports. And that's going to be having another 0.4 percentage point of a GDP shock to the Chinese economy. So considering all these things, I think at least we need a 2 percentage point of fiscal stimulus required by Chinese policymakers to meet this 5% GDP target. And so far, what we learned from the fiscal deficit is that, okay, there's going to be 1 percentage point increase, but we are going to need another 1 percentage point coming from the special LGBs or special CGBs. So we'll find out more about these details later on in the work report.
It's interesting, the PMI numbers that we've recently seen really see the recovery in external demand, right, at a time when we know that external demand is going to take a hit from Trump's tariffs. To what extent do you think what we'll see today is what we've been seeing so far with the overhaul of the private sector, the refocusing on tech companies by President Xi, how much of this has been driven by the external pressures of the Trump administration?
Well, I think for the PMI data that we saw last week, of course, we have somewhat of a positive surprise. But I will be cautious, though, because a lot of the improvement could still be because of the front loading. We just had tariffs announcement coming from Trump, and there's a lot of uncertainty. So I think this kind of front loading could well continue in the first quarter of this year. But I think after this, in the second half of this year, we are going to see a lot more pressure coming on the export side. And indeed, indeed, we are expecting the exports to be just growing at a low single-digit level for China this year. So that's going to be a great GDP shock. I think, on the other hand, on domestic demand, of course, you mentioned that there is maybe some better sentiment in the private sector because of the development on DeepSeek, and we also had the meeting between President Xi and the private sector 2 weeks ago, and that surely I think will be helpful to support confidence a little bit. But I think let's not forget that the overall environment in China right now, we still have the housing sector slowdown that still needs to take time to address, and there's still going to be deflationary pressures that I think I will be paying attention to a lot from the MPC report on how to address tackle these structural issues.
We continue to get these latest lines from China, of course. We are now hearing that they plan a 500 billion yuan new special sovereign bonds for big banks. We had seen some of these plans, of course, from people familiar with the matter to recapitalize some of their biggest banks in the coming months. So we have a little bit more clarity on the size of that support to come at around 500 billion yuan new special sovereign bonds for big banks. We're also hearing about some local government bonds as well. China planning a 4.4 trillion yuan of new special local government bonds. In 2025, also 1.3 trillion yuan of ultra-long special sovereign bonds. So we are seeing this very proactive fiscal policy now in terms of capitalizing banks, but also providing some liquidity to the local governments through local government bonds and special sovereign bonds as well. Michelle, what's your takeaway from these latest numbers that we're seeing right now?
So I would say that overall the size of the special CGB seems to be on the slightly disappointing side, because if you put all these things together, these are less than the 2 percentage point of a fiscal stimulus package, which may not be enough to get China to hit the 5% GDP target this year, considering the external tariff shock. So, but if you look at the bank recapitalization, I think that's broadly in line with expectations. So I think for me, the risk is that right now in the first half of the year, the exports should still be supported by front loading in the first quarter. The consumption stimulus rolled out from the government last year and just now will still be encouraging people to replace their home appliances, the EVs and consumer electronics. But once these front-loading effect of bringing forward the future purchases from the consumers are fading, and I think that may be playing some downward pressure on the economy, and that could put pressure on policymakers to do more to make sure that they hit this GDP target of 5%.
And Michelle, of course, will be watching out for anything to do with their high-tech industries. We have seen the latest shift coming from Beijing when it comes to supporting some of these industries, especially in the private sector, especially around tech. How much could this help in the long term, given all of these risks that you mentioned Beijing is facing on the fiscal side of things, on really when it comes to the consumption within the country being pretty low as well?
Well, I think what we're seeing in the tech sector development is quite positive. For example, we've seen some company announcing that they are planning to ramp up the capex plans on AI. We see maybe more Chinese companies starting to order more chip supply to make sure that they are throwing a lot more resources to make sure they are advancing on these technologies. So I think that could be somewhat helpful for us to see some private manufacturing capex recovery for this year. But I think there are some long-term implications that we need to consider. For example, what does that mean for the job market? I think over the long term, it could be positive for China to help mitigate the downward pressure from the aging population, because you will be having these improvement in the labor productivity. But at the same time, they need to manage these forces very carefully, because increasing AI spending could also mean there could be job cuts on some of the low value added jobs. So I think policymakers do need to manage these two forces very carefully to prevent we are seeing additional downward pressure on the labor market, which a lot of people are concerned about it right now.
Michelle, at the end of the day, it seems what's been weighing the Chinese economy for the longest time has been the property market. When can we expect it to bottom out? And when it comes to the specific details coming today from the MPC, what are you hoping to see?
So I'm not sure if we will see additional support coming from the government, because a lot of the plans are already laid out quite clearly over the last couple of months, which is, I think, the most important point is really to help to reduce the inventories in the housing market, especially those that we are seeing a lot of oversupply. And recently we are seeing some provinces like Beijing, Guangdong, they are starting to issue some special local government bonds to help to buy back these idle land from the developers, which could help support the property developers' liquidity. But these are still being rolled out in a very small batch. So how supportive it can be remains to be seen. I think personally, I think the optimistic case is that we could see some stabilization in the property sector, maybe as soon as mid-year for the first-tier cities. But I think for the low-tier cities, it remains a challenging story.
Michelle Lam, good to have you with us, Greater China economist at Societe Generale. We continue to follow this story. Turn to TLIV Go for more details. This is Bloomberg.
Pretty good pop at the open when it comes to European futures at the moment. This after Euro equities suffered their worst day in 7 months. It's clearly looking to make back some of that decline in today's session. We do have some further lines when it comes to what we're hearing from Premier Li Qiang's work report. In particular, we're seeing the vow to boost domestic demand, to also increase defense spending in 2025 to 7.2%. That's according to reporting from Lianhe Zaobao there. Vows to ensure stability in housing and stock markets, sustained economic growth and recovery, and more proactive, effective macro policies. And of course, so much of this is perhaps very much in line with expectations that we've seen, and particularly when it comes to some of the projections of GDP growth at around 5%, the CPI growth target there as well, and the issuance of some of these new special local government bonds and ultra-long sovereign bonds as well. So, Shery, so far not much has been sort of super surprising. I guess markets in particular will be waiting for the minutiae of the policy announcements, right? Whether we'll see kind of special support for tech, for AI, and that might actually sort of move some of those sectors that have been so supported so far.
Yeah, especially given that we got the big targets, as we heard before, perhaps a worst-kept secret in Beijing so far, because it came broadly in line with expectations, right? When it comes to the growth target, around 5%, this would be for a third consecutive year for Beijing. When it comes to the CPI target, 2%, which was lowered from 3%. But the one that we're watching very closely, of course, the budget deficit target at around 4% of GDP for 2025. And this is really important because, of course, it gives you an indication of how much the Beijing officials want to spend this year, how much they will really be spending in stimulus. The official budget deficit target has been kept at around 3% for years in the past, but now it's been raised to the highest level in more than 3 decades, and really implicitly crossing that red line that signals President Xi Jinping might perhaps be willing to take more unconventional steps to boost domestic demand, given, of course, the issues that we're seeing surrounding trade and geopolitics and what we can expect in terms of tariffs as well. Let's bring in our Chief North Asia correspondent, Stephen Engel, to break it all down for us. Steve.
Yeah, so we were expecting an increase, obviously, of this fiscal budget target to GDP from 3% upwards to 4%, which they have done now. Obviously, the leadership here has been remiss to go beyond 3%. They wanted to demonstrate fiscal discipline, but obviously there is a significant need. The headwinds are facing the economy. They also want to sort of shield the blow as well from those external shocks with tariffs and rising protectionism, and they want to boost the confidence and consumption in the domestic economy. So all along, since we got that first batch of stimulus in September, there's been talk, what's next? Where's going to be, dare I say, the bazooka? we had to wait until the National People's Congress essentially approved that. Now we know that. And we're also seeing the outline of the various bond issuances, the sovereign bonds and also bonds to help sort of recapitalize the banks. And again, the central government has been in years past remiss to be the main, putting the main borrowing burden on them. Because, again, we're seeing a sea change given the debt loads and the fiscal problems at the local level. So that's why you're seeing the central government issuing these. We have, among a number of different measures, 500 billion yuan new special sovereign bonds for the big banks. We have 4.4 trillion yuan of new special local government bonds and 1.3 trillion yuan of ultra-long special sovereign bonds. So again, this is an acknowledgement by the leadership here that the central government needs to take on more of the burden to help alleviate the financial constraints at the local level that was exacerbated terribly through COVID-0. And then as well to shield this economy from those shocks coming from abroad potentially and a drop in exports. They need to boost domestic consumption and domestic confidence and recapitalize the banks at the same time.
Steve, we have the confirmation of the 7.2% boost in 2025 defense spending now. I do wonder, this is sort of a level of spending that Beijing has typically tried to play down, and of course it's always a cause for alarm when it comes to interpretation in the US. What do you make of it?
Well, I think you're seeing budgets being increased around the world in the defense space. You're seeing the Europeans now also talking about increased defense spending in light of what's happening between Russia, Ukraine, and then the United States right now pausing military aid to Ukraine. So you're seeing around the world, as walls go up, you're seeing more spending being outlaid for defense. This shouldn't be too much of a surprise for China. It doesn't necessarily mean that China is going on the offensive, but again, they are preparing for any eventuality. They are modernizing the PLA. We all know, of course, we've had a number of high-profile sackings of PLA leadership and generals. There's been a very comprehensive review of discipline within the ranks of the People's Liberation Army. So an outlay of increase of 7.2%, if that's the number that is actually going to be announced in the work report, would be in line with China's efforts to modernize and to expand its military capabilities amid, obviously, some global instability.
How are we expecting all of this to play out in the markets? We are not seeing much movement when it comes to the offshore yuan at this point.
Well, I think a lot of the things that have been announced pre-work report are in line with a lot of expectations. That's why you saw in the markets yesterday, I think the markets were on more tenterhooks about the retaliatory countermeasures on tariffs that China would announce. And it was fairly measured. Again, on just about $22 billion worth of U.S. products, mostly in food crops like soybeans, corn, and wheat, and also meats, beef, and pork, and chicken. They still have not necessarily rolled out further export bans on rare earths and critical minerals, perhaps saving that further. They did that a few weeks ago on tungsten-related minerals. They did it as well in December on germanium, gallium, and other minerals. So they still have that quiver, that arrow in the quiver to do that. And that's where the market is looking at as well. But I think some of these, outlays for fiscal spending should be, received positively by the market because it didn't necessarily disappoint. It didn't undershoot, even though there has been momentum in the Chinese economy and increased confidence spurred by DeepSeek and other innovative, moves by the Chinese over the last couple of months. So we've been on tenterhooks. I've had a number of economists tell me, show me the money. And it looks like the work report is going to show us the money, the fiscal outlays, and the added burden that the central government is going to take on.
And, that 7.2% rise in defence spending, same as last year. A lot of these targets are fiscal deficit, some of the bond targets as well, perhaps undershooting market hopes for something a little bit more robust. But it was interesting, in our sort of live blog, we're talking about the reference to belt tightening that makes a return to this work report. It was omitted from the Central Economic Work Conference readout from December. Does this give us an indication that, this process of structural deleveraging, which has been a top priority before the economy and relations with the US sort of turned south, right, it still remains a focus for Beijing, or at least a pretty difficult balancing act?
It's always a difficult balancing act, for sure. It was last year at the National People's Congress and the day after that where we had that very interesting press conference where we had Pan Gongcheng of the PBOC, we had the finance minister, we had the NDRC, we had the economic czar, all on a dais, all kind of reading from the same playbook. And the line that was repeated over and over and over again by all of them was what you just alluded to, Heidi, and that is belt tightening. Fiscal responsibility. They were going to promote, of course, these dynamic new forces and the big three and the like in batteries, EVs, and solar, but that elsewhere, extravagant spending was going to be reined in, and there was going to be a collective belt tightening. It'll be interesting again to see when we get that lineup of finance officials, most likely tomorrow afternoon, to see how much that is going to play out as well. If they're going to lay out this fiscal spending, there will be budget or belt tightening in other areas, and that's what we would like to hear from them. Also, again, I really want to hear from Pan Gongcheng on whether there's any change in the stance on the renminbi. Could there be, dare I say, and it's over cliche use of this, but a weaponization of the renminbi? By all accounts, Pan Gongcheng and the PBOC have maintained that they want to keep a stable renminbi exchange rate, right? In the first Trump trade war, we didn't have that mantra. We had a weakening of the renminbi, dare I say weaponization. And the renminbi weakened more than 11% against the US dollar over those 2 years after that. So there could be some movement depending on what they have to say tomorrow.
Our Chief North Asia correspondent Stephen Angle in Beijing outside the Great Hall of the People there, as we'll continue to check in with Steve, just going through that work report ahead of Premier Li Qiang's speech. We are getting some breaking news crossing the Bloomberg when it comes to personnel changes at the RBNZ. The Reserve Bank of New Zealand Governor Adrian has announced his resignation. He'll be finishing up in the role on the 31st of March. We have, this is really sort of surprising, particularly as the RBNZ is still in the middle of trying to steer the New Zealand economy out of a deeper than expected recession. You've got the jobless rate rising to a 4-year high. You've got consumer spending on a lot of deeper than expected economic contractions being seen across the second and the third quarters of last year. Demand very much still weak there as well, right? So we are now hearing that the Deputy Governor, Christian Hawkesby, will be acting governor through to the 31st of March. From the 1st of April, the Minister of Finance, on recommendation from the RBNZ board, will appoint a temporary governor for a period of up to 6 months. Mr. Hawkesby will also chair the Monetary Policy Committee during that time. So it is quite shocking when it comes to this resignation from the RBNZ Governor, Adrian Hall. He's really been steering this difficult sort of economic path, particularly with the RBNZ as being one of the earliest central banks in the world to both embark on the previous tightening cycle and now also the easing cycle as well, given the steepness of the recession. And we've seen, of course, some pretty big cuts to the OCR by the RBNZ and some very sort of confident moves there from the RBNZ and Governor Orr. So we will continue to bring updates, but that resignation of the RBNZ Governor, Adrian Orr, just crossing the Bloomberg now. More ahead on the Asia trade. This is Bloomberg.
We're headed towards the China market opens. We're watching the Chinese yuan right now. Of course, we got the latest growth and CPI targets, not to mention the budget deficit target of China, around 4% of GDP, the highest in about 3 decades. Investors watching this closely as we're watching the NPC. Asia equities reporter Charlotte Yang joins us now. Charlotte, what will traders be watching for today's announcements in order to gauge the direction of where markets in China go from here?
Yes, I think the most highly watched headline figures has already been out, the GDP target, the deficit, the consumption price target. From what we're hearing, that's mostly in line with estimates from Societe, so there's no big surprise there. But what this sends a signal is that the government will continue, with the support to the economy. But I think going forward, it's going to matter. Traders will be assessing, the transcript in the speech, as we'll hear later this morning, for example, which sector they mention first. Is it going to be tech, AI, or consumption? And so, for example, for consumption, some of the traders are expecting we could see probably more trading programs, so it has really been boosted, the smartphone makers, electronics makers, and also with property as well. We're seeing some early signs of stabilizing, but they want to hear from the authorities, from the government, in terms of how they're wording the sector.
So beyond the MPC, what's going to be key when it comes to market momentum in the next few weeks?
Yeah, so MPC is definitely the big thing to watch for today. But then we're also having the U.S. the State of Union address. So traders are also eager to hear how the U.S. imagine describe the relationship with China and anything that might come with Taiwan in the geopolitics front. And also, we also have a lot of earnings coming up. We've had Alibaba, Baidu in the past weeks, but we're having JD, which is a company that represents that people usually the traders use them to gauge the consumer recovery, is reporting tomorrow. We also have Tencent, Xiaomi in the upcoming 2 weeks. How these companies report in terms of the AI capex, the also outlook for in the tech front monetization as well as consumption. Those will be closely watched.
And of course, we're watching the tariff threats coming from the Trump administration. The markets seem to have reacted pretty calmly so far. What are investors' expectations right now of how this plays out, that we're not seeing these drastic moves, at least for now, in the Chinese markets?
Yes, I think so far, if you're looking at, the pricing actions, for example, yesterday, market has really not really been so worried about this. And I think the reason is that, first of all, the retaliatory measures we saw from the China side, there's been a lot of headlines, but they think it's still so far relatively targeted and measured. And also, I think this really is going to be a rolling basis, where it depends on what U.S. do and what China do in terms of government response, and also maybe with the currency side, to gauge the material impact on the economy.
Charlotte Yang, good to have you in Tokyo. Usually in Hong Kong, Bloomberg's Asia equities reporter here with me as we continue to watch these different sectors that could get affected by these tariffs. Of course, we were talking about tariffs on China, but really the semiconductor sector, auto sector, and of course, we have seen some more retaliation when it comes to agricultural goods. So those are some of the sectors and related names that we'll be watching in today's trading session, especially when it comes to really those high-tech drivers and what that momentum could mean for the future. And it's really been about that focus on semiconductors. Right now, chip designer ARM is set to sign a pact to establish a base in Malaysia. The Anwar government has pledged over $5 billion to support its semiconductor industry, seeking to increase its role as tensions between the U.S. and China shake up global supply chains. Let's cross over to Kuala Lumpur, where Insight anchor Hazinda Amin is standing by with our next guest, Haz.
Well, Shery, you may not know this, but Malaysia is actually the 6th biggest exporter of chips. But at the tail end of it, it wants to climb up that value chain, and perhaps this deal is what they're looking for. Joining us now is Rafizi, Malaysia's economy minister. This is, of course, an exclusive interview. That deal set to take place later today. Minister, good to have you with us. Talk to us about the significance of this deal with ARM. How does it affect your chip ecosystem?
We have always wanted to move from the back end, which is on testing and assembly, to the front end, where in terms of the value, the back end only captures about 10 to 15% of the value of the supply chain, whereas 60% is more or less at the front end. But it's a lot more difficult because obviously it involves IPs. And if we were to wait for our own expertise to develop organically, most probably it's going to take much longer. So the government has taken a radical approach where we work with ARM, which is a market leader in IP architecture, with the perspective of building the whole ecosystem, and that will be able to complement our strength in back end, and then will accelerate our move towards the front end.
Just putting it out there, this is the first time ARM is actually signing a deal with a government. All the other times they were signing a deal with companies.
Yes, that's as far as we are concerned. This is the first time that ARM is signing an agreement with the government with a total view of building an overall ecosystem with the country.
IPs, access to IPs is not free. How much are you paying for that? And how many IPs are we looking at?
We have different layers of access. Predominantly, it's made up of 3 different layers. At the bottom of it is what we call ARM flexible access. This is where we allow startups and IC design companies access to a library of IPs. This should bring down the cost of R&D and entry into IC design significantly, and with a view of using this to also build the pipeline of engineers. The next level is compute subsystem. This is more or less designed chips that are almost ready to be used. It just requires some further design.
So, Minister, how many IPs and how much are you paying for them?
It's a $250 million for a 10-year program. And we think it's going to be consumed much faster than 10 years. And if it works well, and if we are able to get the final result that we want, then there's always consideration whether we want to scale this up further. So you're looking at 25 AFA, 7 compute subsystem, and a further access further down the line that we will announce in due time.
Quantify the impact on the economy. We're talking about a $250 million investment. Will that translate to perhaps an additional 1% growth to GDP?
Yeah, it's the rule of thumb is one compute subsystem based on the market now. If it tapes out, we'll be able to create a chip company with a revenue of about 1.5 to $2 billion per annum, just one company per one compute subsystem. So you're looking about, hopefully we'll be able to create between 7 to 10 companies, and that alone will be able to create at least $15, $20 billion revenue per annum. Not to mention the subsequent spillover effect to the overall ecosystem. So it's certainly something very significant for the.
So 1% to GDP, 2% of GDP.
I think it's fair to say that it will be able to go beyond 1%.
How quickly do you think Malaysia can produce its own chip?
We are trying to do it maybe between 5 to 7 years, because with the collaboration with ARM, it shortens the time for R&D into going to the market. So I think 5 to 7 years is something that is doable, especially when we are also trying to focus on building data. Server racks for data centers, because there's already demand for it in Malaysia.
Reports have suggested that ARM itself is interested in producing its own chip. Of course, right now it's just licensing IPs. Would Malaysia be part of that?
I wouldn't know, because...
Would you be interested in being part of that?
We'll be more than happy. And obviously, there's some kind of, special relationship that builds this collaboration. I don't know what is ARM's plan, but I hope that we will be able to build this collaboration.
Let's talk about what you know. We know that GDP is poised to grow 4.5%, 5.5%.
Yeah.
Given the uncertain environment, is that still achievable? Would you have to perhaps review that growth target?
Not at the moment. I think we have a pipeline of investments, and I think the fundamental is still strong. Of course, everyone in the world now is reviewing how things are developing, but not at the moment. I think our projection is that it's going to be between 4.5 to 5.5.
All right, such confidence. Minister, thank you for joining us. Rafizi Ramli, Malaysian Economy Minister. Heidi, handing back to you. Of course, it's a momentous occasion for Malaysia on the cusp, perhaps, of producing its own chip.
Hassan Amin there in Kuala Lumpur there. Let's take a look at how we're shaping up when it comes to both US futures at the moment after what was really another volatile session, with some hope being injected when it comes to the tariff relief side of things, hinting that we heard from the Commerce Secretary Lutnick that potentially there could be tariff relief on the way for Mexico and Canada, if not for China. This is a picture when it comes to S&P futures, a little bit up to the upside there. We're also seeing Taiwan futures trading in positive territory in that last trade for A50 China futures up 0.3%. Not a great deal of surprises when it comes to what we've heard from the major headlines of Premier Li Qiang's work report, but he's due to deliver that report at the Great Hall of the People, as you can see on your screen there, in just a couple of minutes' time. So we will sort of wait to see if there's more clarity, more detail when it comes to specific spending, given that the spending, the deficit, the GDP, the defence spending targets were all more or less in line with expectations. This is Bloomberg.